Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. Hey, Value Builder community. So today I have an amazing guest here, Christopher Borden. He has an amazing story. I know just a little bit about him, but would love to dive in deeper. So he's a former CEO, co-founder. Well, he's existing CEO and co-founder of Rise Capital. But Chris has dramatic career pivots, which in the last 25 years, he was in the corporate C-suite world, running one of the largest and second largest retail food chain, $1 billion corporation in Hawaii. He moved with his family to Utah, and he is in multifamily space for, probably 5 years, but we'll dive in deeper. So he has a really, really interesting, story coming from corporate and running right now a multi-million-dollar multifamily asset portfolio and being in that space. So that's fascinating story. So what you will learn today, you will learn how to pivot from successful career to another successful career and why it happens. And I think many of you are on a similar journeys. Chris, welcome to the show. And of course, if you can give us just a high level about your story. And of course, we want to dive in. How did this happen from a successful C-suite? Everyone thinks cushy job and lots of benefits, not a lot of stress. Jumping in commercial real estate, getting inspired and addressing all those fires that comes in our industry.
Yeah, I'm going to summarize. I'll give a bit of background. First off, thank you for having me. Honored to be here. But I think it's more about freedom. And a lot of times people chase investments looking for wealth. But at the end of the day, it's more about freedom and options than anything else. A little bit of the backstory. So I had a very successful career in retail. So if you guys have ever worked retail, you guys have to know it is probably one of the most stressful jobs out there, inclusive of, you have a multifamily property, even a large multifamily property, you maybe have 1,000 rooms, and that's a super large multifamily property. On any given day, we'd have roughly about 500,000 people enter our stores. So not even the same scope. Like, it's completely out of range of the scope of logistics and stress that comes along with retail. So much different. But for me, again, it was my wife and I had really successful careers. Obviously, we worked really hard. I actually grew up on the island of Molokai, which, if anyone knows Hawaii, knows it's a very, very small island. I grew up on a farm. I grew up farming, but I had parents that drove us to get good education. We did the normal, typical American path, right? Go get a good education, go get a college degree, and then go try to be successful within a business, and which is exactly what we did. Both my wife and I were successful, and we actually didn't pivot into real estate. It was a little different story. So we pivoted again. We were successful, so take some of that with a grain of salt. And we actually retired. We moved to Utah to retire. Everybody asks why we moved away from Hawaii to Utah.
Yeah.
So our kids are older. My wife and I started really young. We knew we wanted to have a family, and we knew if we can start younger, it'll be more freedom for us. We'll take the harder part at the earlier part of our years, where we can handle a bit more stress, and then after that point, now life looks a lot different. So again, we planned our lives, we worked hard, got to where we're at in the career. So we decided to retire away. Again, I was working 7 days a week. Literally, again, almost 100 hours. People ask me, how can you work 100, 120 hours? It's possible if you hardly get any sleep and all you do is work. And that was my life as a CEO of a grocery retail chain. We moved away. Why Utah? Our kids moved away. Our kids were older. They moved away. One went to the military, one went to college, and they both didn't want to come back to Hawaii. So Utah was geographically in the middle of our two kids, which we wanted to be closer to. So how real estate came to fruition was more, we were still young. So we retired technically. Retirement, we just had freedom from our W-2s. Again, it's more about the freedom and options and choices. So we made investments. We actually bought our first house when we were 19. We shortly after that bought I think we were maybe 22 years later. We bought another house. We rented out the first house, and we weren't investing. It was just, we knew we didn't want to pay rent, and okay, let's bring somebody in to pay the rent. There was no strategy behind it. It's just, we knew it was the smart thing to do. Like at that point in time, again, this was a while ago and we were younger. So fast forward to moving to Utah, again, more about options and freedoms. We were still young. We knew we wanted to do something. We said, okay, let's kick up the real estate thing again. And we did not know what we wanted to do. It was a journey to figure out what we wanted to do. So we started off, we bought a few single family houses. We quickly realized we did not want to do that. Just for scalability. We didn't want we didn't want to get the calls in the middle of the night from tenants flushing something down the toilet that they weren't supposed to. There's a myriad of things that go on, like you alluded to in the beginning. And then we pivoted. We kept pivoting, navigating to where we started to feel comfortable. Now, again, me having the background, the C-suite background within a business organization honestly led me more towards the commercial real estate side of things. Now, you mentioned multifamily. We're pretty agnostic on the assets that we invest in. We have multifamily. We do ground up development, build to rent, RV parks, storage units. We're pretty agnostic. We don't have any industrial, which I want to get to talk to you more about, but that's sort of the natural progression, because commercial is treated more like a business. It's operated, run like a business. There's a P&L, there's a balance sheet. You can implement operational strategies, marketing strategies to improve the asset, improve the income, and then improve your overall return. You sort of can do that with single family. It's just not the same. It's not scalable to the degree that commercial property is. So we navigated naturally into commercial property because of my background. And then in addition to that, we segmented and pivoted because of, so again, asset classes, pretty agnostic. Geographic location is pretty agnostic as well. We have stuff from California all the way to Florida. And we have assets literally in between, not every state, but several of the states in between there. And we like to be diversified between risk, geographic risk, asset risk, and just overall general risks. We also started sort of in the beginning after we acquired the first two assets. Let me take a step back too. The first investments we did into multifamily wasn't through us. We went through another syndicator and we came in as an LP so we could understand a little bit more of the fundamentals of how it works. So we did 2 or 3 deals where we were just LPs. And then we navigated to what's called a co-GP position. And then we navigated to, okay, let's just acquire our own assets. So even that went through a progression. And somewhere between the LP and the first coach EP, we started lending out capital as well. So just to diversify that risk profile. So most of our portfolio is allocated towards debt. And then a slightly smaller portion of the portfolio is allocated toward equity. And then even a smaller portion of our portfolio is allocated towards venture capital. So again, it's kind of more about that diversification play. So long story. So hopefully there's a lot of tidbits.
No, this is great. This is great. Yeah. And definitely with your background, definitely, I think you're just tuning in and finding what are those are the best KPIs. I love the approach of it being agnostic, diversifying. Yeah, it's a very interesting approach, and I commend you for that. I wanted to ask about the debt position. So your debt positions, you typically go on a first mortgage, or you are more in a debt to equity mezzanine type of financing, or both?
No, for the debt we structure only first position notes. Again, it's more for the risk mitigating factor. I mean, if we let me go back and think. I don't think we ever did mezzanine debt. We funded commercial properties, but in first position. Again, for those of you that are, again, new to it, understanding risk is to me, extremely important. I
Oh
don't
yeah.
think we talk about the risk side of it enough. That we talk about the
Yes.
returns. A lot of people just see the returns and they don't necessarily understand the risk that they're taking on for those returns. And
Hmm.
you need to, the proper way to build your portfolio is to allocate. And again, it's going to be different for everyone,
Hmm.
but it's to allocate out the risk where you feel most comfortable for growth. And every asset, I don't care what anybody says, is cyclical, right? There's
Hmm.
ups and downs with any asset class in there. There's ups and downs with any market in there. Being able to diversify between, again, that's why we diversify between asset classes, why we diversify between geographical locations, and why we diversify between equity and debt. But debt is structured in first lien positions. Sometimes it'll be a second lien if we have control over the first lien. It's necessary for us to maintain control, and we want to go at a real conservative loan to value on the debt side of it. So again, if something happens, everyone knows, right? If you have a property and something happens to the property where you can't perform, the bank's going to take it back. Sometimes they take it back at a hair trim, but normally there's very little loss for the bank or the first lien position. So that's why
Yes.
we want to have, you want to be able to allocate whatever you're comfortable with, right? At the end of the day, investing only makes sense if you can sleep good at night. If you can't sleep good at night, why are you doing it? Like at that point, it doesn't make sense.
Yeah, it totally makes sense. So on the debt investments, what are your typical projects you invest? I'm assuming they're mostly value add, ground up, or heavy lifts, right? Or are there any steady Eddie where you just park the money for?
Normally, they're residential properties, either brand new
Mhm.
ground up development or, like you said, heavy value add lifts. I mean,
Mhm.
let's just say value add. Sometimes it's heavy, sometimes it's light.
Yeah.
It all depends, but typically it's going to be that structured in, like I said, first lien positions. We typically fund up to almost 80-90% of the total project cost, but it is
Mhm.
at the highest we'll ever go is about a 70% loan to total value. And the
Mhm.
bulk of the money is kept in an escrow account and pulled out in draws as values being added to the asset. So the more value being added to the asset, the larger the gap between our money invested and the total equity cushion that you have there. So again, it's just a way to keep the capital that much safer.
Makes sense because do you mind, and I'll give you a pass if it's not appropriate, but do you mind sharing what's the range typically on the first lien positions on those residential projects right now? What's the typical rate? Let's assuming sponsor with experience, middle of the road sponsor with a good credit and has past experience building the same projects. What would be the range typically on the rate and the points?
Oh, okay. So note that we typically only do residential. I would say
Hmm.
95% of the portfolio on the debt is residential.
Hmm.
We normally stick between, well, we normally don't like to go over a one. Sorry, this is depending on the market, but in the
Yeah.
Utah market, roughly about a $1 to $1.2 million ARV. We normally
Hmm.
don't like to go higher than that just because it limits our exit.
Yeah.
On the total loan amount, it's typically up to 70% of the total loan.
Hmm.
I mean, we've had loans at like 13% of the total value amount. So it
Hmm.
ranges, but we wouldn't go over that 70% mark. Terms depend on what they're doing. If they're
Hmm.
doing a value add, it's typically about 6 months. If they're doing a development, it's 9 to 12 months. It just
Hmm.
depends on exactly what they're doing. The rates range, points range as well as far as experience. The rates normally are about somewhere in the it's equitable to the market, somewhere around
Yeah.
12% of the total amount borrowed. But we typically do not pull credit. For those of you that are kind of listening, some of the larger entities will pull credit. We more focus on the actual asset and looking to make
Mm-hmm.
sure, one, experience. We want to make sure that there's experience and the reason is, again, we're secured originally by the asset. We secure the asset itself, and then the bulk of the money is held in reserve as
Mm-hmm.
work is being performed. So work's
Mm-hmm.
being performed, the asset gains in value, or the money is secured at that point. It's just another way for us to strategize on again, that whole value add proposition out there. But there's a lot of nuances with it. There's a lot of things that people should look out. If you're on the other side or you want to borrow money, I would say probably the biggest thing to look out for is read through the contract. I've seen contracts where it would actually absolutely bury someone.
Yeah.
And I've seen contracts that were in favor of the borrower. We're on the spectrum of we want the borrower to succeed. The more the borrower succeeds, the more they're going to come back to us, the more reciprocating of the opportunities come to fruition. So for us, we don't like to foreclose. In fact, we've never foreclosed on a property. We've done in north of 30 million in loans since we started, have never foreclosed on anyone, and all of our deals have come back through fruition.
Did you
And
have
hopefully
to
keep that
take
track
over?
record.
Did you have any projects you had to either take over to finish them or no?
We had one project that we had to take over and finish. Yes. Still that particular one wasn't a foreclosure. Normally when that happens, you normally make more money. I mean, that's normally what happens. And that's why there's entities out there that would like to take back the property. We just don't. Again, we want to make it full where everyone's succeeding.
So you're servicing your loans in-house, just like with your banking and with the spreadsheets, or are you using the servicer? I'm just trying to get a flavor.
We have a full system that monitors everything. So they submit draw requests in the full geo tracking. So full system. So geo track everything that happens. We won't necessarily go to the project every single time they ask for a draw. We normally visit the project once or twice, somewhere in the beginning and somewhere in the middle. Outside of that, draw requests come into the system, gets geo tagged, supply images or videos, all geo tagged, timestamped, all tracked, so we know that it's all valid and legit. And then once receipts are all verified, then draws get submitted. Loans come in through just like a website, looks like a normal website. They come in, fill out a quick application, takes about 10 minutes, 15 minutes to fill out the application, and then we process it through our systems. Pretty sophisticated system. We did all build it in-house. So we have a few tech people on the team that can help navigate and build out these things for us.
Yeah, definitely. I can see that your past massive operation tech skills coming in place here. Right? I can see that.
Absolutely.
This is great. Yeah. Awesome. Yeah, this is right. Very interesting. I've seen something like that in the past, but I don't think many people do that, right? So that I'm just thinking, just from IRR perspective. So are you guys just using your capital, or you leveraging? Because if you're mentioning 10 to 12, as a GP, right? No, we always want to strive to, not to throw weight here, but of course we're trying to go 20-30% IRR, so we can pay half to your LPs, and that's how it stay afloat, unless you're doing that with your own capital. So do you leverage your capital, or you just have that is satisfaction on 10 to 14% IRRs? How do you extract more money out of that money?
Yeah, we're not at the point where we can leverage. I don't know fully how I feel about leveraging the capital. Anytime you leverage, you add more risk. So
yeah.
I can see the intrigue to leverage the capital to increase your overall rate of return. But again, you're introducing additional risk. And you've seen banks, I mean, we've all seen it, right? Especially where banks completely over leverage and they're out of business. I mean, it wasn't even that long ago where we had a few banks go out of business from over leveraging. So I don't know how I necessarily feel about it. We do not leverage right now. So, but what we do, and this might be a little unique. You got to maybe understand the reason. So we have a fund and we bring other investors into these same opportunities. Now we started doing it ourselves. So before I even started the fund, we were somewhere around north of 15 million lent just on our own. So we've been doing it for a few years before we even brought in the fund. And the only reason we brought the fund in is because I started having friends and family asking, how can I get into these opportunities as well? I was like, okay, you can't just start taking people's money and start lending it out. You run into SEC legality issues. So we said, okay, let me go talk to an attorney and figure it out. So we started a fund to be able to leverage it, but it's more selfishly driven. So what I mean by that is it's selfishly driven for the fact that I can always have my money working. Like I very rarely will have money sitting on the side. It's a little slower. The market's a little slower now. So I do have some little bit of money sitting on the side, but it's very rare that money's just sitting there. Again, no one should really want money sitting there. They want enough for reserves, and then the rest should theoretically be invested, again, predicated off the risk. But we charge our borrowers 12. We give our investors, depending on what they invest, but we give our investors 12. So we're just taking a points, but my money's in the deal. So again, more added security for the investor, but more added benefit for me because again, my money is always physically working. I don't necessarily have a time where my money's just sitting on the side in general, if that makes sense.
Yeah, and the points cover the operation cost and stuff
And
like
the
that.
points cover the
And your
operation
investors are
costs.
happy, you know?
Yep.
So if we lend you money, putting you on a spot, your payout's about 12% to LPs?
Yeah, depending on what they invest. So if they invest over 200,000 or above, then it's 12%. Anything under that is 10%.
Yeah, and what's the lockup typically, roughly? What's the lockup?
About 6 months, like I said,
6 months?
6 to 9 months. Yeah.
That's very fair, you know. And it's in Utah, or can I touch the asset close by in Midwest? Do you have any investment here?
Yeah, we're normally we lend primarily in Utah just because we're here. We do also lend in Hawaii as well because one of our team members there. We lend in Idaho because it's really close to where we're at. It's only a few hours drive away. If anything needed to happen, we could do that as well. And we're contemplating starting to lend in Colorado. If you guys are looking at lending though, so if you guys are looking at lending, just be careful with the laws. Some states are judicial, some states are non-judicial. Some states you need a license. Utah is one of the states where you actually need a license to originate. There's a few states where you need a license to originate. So I have my license. And so you just have to be cautious and careful and then really understand the deal, right? It's important when you're lending to really understand the market. Utah's been a fabulous market. Idaho's been a fabulous market as well. I don't anticipate everything staying status quo for the next few years. I don't anticipate an upswing or a downswing, at least within the Utah market. And you have to kind of understand the market to be able to lend. And then again, understanding lending too. I mean, if you're super conservative on your loan to value, then you're probably fine in any market, right? If you can get a 50% loan to value on a loan, you're okay almost anywhere. I mean, there's never been an area in the entire United States that dropped more than that within a short time frame. The highest was I think back in 2007, 2000 through 2013 was, believe it was Nevada, and they fell 60%. The total value fell 60%, but it took several years to get there. Again, if you're looking conservatively, if you're looking at lending and you want to try and tap into it on your own, I think it's a fabulous vehicle that everyone should get into, especially if you have like an IRA out there. Those of you that have done investments know that equity investments can carry added taxes for your retirement account. Debt investing doesn't. There's zero tax liability on if you're investing directly in debt through a retirement account. So those are another options that people can kind of look through. And then again, why we like to diversify right there.
Every week I read hundreds of commercial real estate articles from across the US and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Proforma underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys.
There's different strategies. There's different benefits. You can definitely get greater tax benefits by investing in equity. You have zero tax benefits by investing in debt because it's just ordinary income. But then again, depending on how you're investing, the strategies, it's good to be able to diversify just between the strategies for kind of like optimizing your total return, your tax liability, and so on and so forth.
I really appreciate for sharing this, and my light bulbs just going off. And I've heard in the last couple of years when caps decompressed that quite a few folks from my circles to start doing that, different debt vehicles, right? But I never got in conversation with anyone. So what begs me, and I've done personally some loans to rehabbers here in Chicago who I know personally, just one off maybe once a quarter, 200,000 loan there over there. But I never treated it as a business, right? And so the question begs me is that, yeah, so you deploying in a debt seems, collecting those payments on ECH was never a problem for me. My thinking, but I'm thinking about how labor intensive then it is to get those borrowers when you get to the consistent scale, right?
Oh,
So
it is.
Mhm.
Yeah. There is a dichotomy between money and deals. So unfairly, we also own the largest. I'm not sure if you heard of a RIA, but we own the largest RIA here in Utah as well. And so a lot of the deals gets funneled through there. But it's all about, it's all about creating relationships. It started off with one deal, and I was literally at an event, and I didn't know what the heck I wanted to do. This is after I think we bought 2 or 3 houses, and I was like, I don't know I don't want to do this. I know I don't want to do this. So I don't know what I wanted to do. Someone came to me and said, here's a project I'm looking at. I was like, oh, cool. Let me look at it. It's like, yeah, I don't have money though. I was like, oh, well, I have money. Can I make it make sense? And then after that point, it's just doing research, like protecting yourself or finding somebody that you trust that does it. But protecting yourself and kind of understanding just fundamentals of real estate and how that all works. And then go probably talk to an attorney, get your contracts drafted up, make sure you fully understand the contracts, what you're getting into, the legal liabilities, again, understand your state laws as well. And then after that point, it's honestly debt is significantly less work than equity. Equity, there's always something that you have to do. Depending on what asset, you do a lot of industrial, maybe probably a lot of double, triple net industrial side of things. So maybe a little bit less, but especially when you're looking at the multifamily side or things with multiple tenants, you're definitely going to have more stress. Stuff is going to go wrong, especially if you're not on a triple net. Obviously, if you're on a triple net, then life's probably wonderful. Not every commercial property is triple net either, right? Yeah,
not really. No, it's we're mostly dealing with a small bay industrial. So it used to be called Section 8 of industrial. Right now, it's called business. It is right now they call it apartment complex for businesses, just because it just becomes popular, right?
Okay, so there's a lot of stress that goes along with it.
But there is a lot going on. There is a lot going on,
like on debt, there's normally nothing. On debt,
same story. Like people want higher houses until they have 100 houses. They don't want anymore.
Exactly.
1 million square feet in industrial until they have millions square feet in industrial. This is not what I expected right now.
So kind of think about it too. On the debt side of it, you find the borrower, you originate the debt, and then after that, it's a once a month check-in. Hey, how's the project going? Give me an update. Or they're going to send you a draw request. And again, if you have the system and processes, for us, it takes us about maybe 10, 15 minutes to process a draw request, validate all the receipts. Again, if you have a system, it's geo-tracked, it's all valid. Yeah. So validate it, add it up. Yep, this makes sense. Issue the draw. Literally 15 minutes once a month for something that you're going to take 6 to 12 months and then recoup your earnings. So it's significantly less stress as far as like just from the operational standpoint. Again, you're not going to have the higher returns, right? There's zero upside, zero tax benefit. So you guys got to know this. It's not all butterflies and rainbows, but the key is about, for me anyway, the key is about the diversification of risk. I know, right? I lost on an LP deal that we had on multifamily. Literally lost. I think I invested about $250,000. All of it's completely gone. They had to close the asset down. That's gone. Now, I've never, again, like I said before, we've never lost on the debt side of things, regardless of the market conditions. Now, we've had stuff hold back longer, but normally if it holds longer, we're still getting a return because it's a fixed rate of return. It's a fixed contractual rate of return. And we've only had to take a property back once. And like I said, the time we took it back, we actually set it up as a joint venture. So we both won regardless.
So, yeah, but I just want to really just go back to the question on expenditure of time. Let's say my expenditure of time chasing deals every day, every single day. I'm chasing deals, right? You're trying to find deals. On chasing borrowers, good borrowers, is that the same? Is there a salesperson in your company, or there is so many of them that actually you just don't have to?
Yeah, no, we do some sales outreach on that side as well, but it's the same thing. I mean, you once you set up the funnel, once you set up the communication, right? You talk to everybody day in and day out about
Hmm.
Section 8. I've never heard that before, but about
Yeah.
Section 8 industrial. You talk about
Yeah.
it all the time. So the more you talk about it, the more it comes to life. The more it comes to life, the more opportunities come to you. It works the same way regardless of what you're looking at. I don't
Yeah.
care what asset class you're looking at. The more you put it out there and the more you give it life, the more
Mhm.
opportunities will automatically come to you. So we get referrals from referrals from referrals by now. We've
Mm.
been doing it for a while, or we even partner up with other lenders in our state that we've made relationships with, and we share opportunities. So if I don't have enough capital to fund, I'll share the opportunity and vice
Mhm.
versa. So there's typically always some opportunity. It's just at the end of the day, real estate it's is a numbers business, but a lot of it's
Yeah.
about relationships.
Always
It's a
business,
very,
100%.
very huge relationship driven organization, much more so than it was in my previous career. In my previous career, if I walk into a competitor's store and they knew who I was, they'd ask me to leave. Like that's how it would work. It does not work the same way in real estate. It's like this, right? We're sharing ideas of what you do because it's going to get reciprocated. I think I seen a post with you. You're going to get faster further when you have more people, right? When you
Exactly.
you don't, instead of 100, I think I seen something from you, 100% of $20,000 deal or 40. I would rather take
Yeah.
2% of $100 million deal,
Yeah.
right? And then allocate and split out the workload there. And then that is kind of the mindset of abundance. And like I said, the more you give it life, the more opportunities flow to you.
That's awesome. That's amazing. Yeah, I think I'm almost sold. I'm gonna ask one more question about the business. So let's say for your LPs and then the first deal, would you be able to tell me to ask LPs permission to invest, or they just put in your fund and it's your discretion when you lend the money,
Nope.
or
Our fund is actually set up as a customizable evergreen fund.
okay.
It's evergreen means that it theoretically lasts forever.
Mm-hmm.
And it's customizable to that because we also do equity in the fund. So it's
Mm-hmm.
not just debt, it's just primarily debt because of, again,
Mm-hmm.
it's more of the asset allocation. How I believe I want to invest is how I want my investors to be able to invest as well. So they actually have the opportunity to select. It's not a blind fund. For those of you who are new to this, a blind fund or a pooled, and there's benefits both ways. So kind
Mm-hmm.
of take it with a grain of salt. But a blind fund is I invest capital. Normally, they'll detail out a list of assets that they're looking at, or they'll have a business statement and say, these are the type of assets that we're going to acquire. And then they just acquire the assets. And you are still diversifying in a blind fund, which I like.
Mm-hmm.
That's the part of it that I like. You're diversifying between multiple assets and you take it on risk. So if a fund has 20 assets in it, one asset doesn't do well, like one asset completely loses, you still have 19 assets that help uplift that one asset. So there is benefits. On our fund, it's again customizable fund where the investors actually get to go in and select the investments that they want to invest in. If they want to invest in it, they can. If they don't have to. So it's the discretion is up to the investor, which again can be a con because then some people want to just have their money invested and not have to worry about it for the next 2 or 5 years,
Mm-hmm.
whatever the case might be. For ours, you typically have to be more active as far as because it's short term. 6 months come up, the money comes back, you have to go select another investment. We do give the option to our investors to say, okay, if you don't want to do that, just sign this document that allows us to
And I'll
completely
do it for
control your
you.
money, and then we'll move it into the next available deal. So it's customizable. So there's the option for both, but our fund is set up that they get to select the deals that they want to get into.
We'll take it off the call, but I think I want to try it out. You're gonna send me a couple of projects. I still want to see the project.
That's awesome. See, look, see, again, you never know. You never know what transpires from the conversations that you have, and that's why I love it.
Exactly.
Real estate's been phenomenal.
Yeah.
I wish I would have got into real estate a lot sooner. For us, is kind of closing it off. For us, we actually do a lot of philanthropy work. I said, like I said before, we did really well in our careers. Real estate started for us because we didn't just want to sit at home. We wanted to do something, get out to meet people, add value to the community where we can. And then it kind of navigated. And through all of these transactions, there's more relationships that came to fruition. And one of the relationships was through a nonprofit that we started in Africa where we're bringing economic opportunities. We have some very, very large goals. Our next goal for next year is to open up a university where we can teach engineering. There's like
So tell me more about
structural
how did
engineering.
you set it up? What's the structure of it, and how do you help? Is it only sending the funds, or I'm very curious
No,
about it.
it's more. So originally, my wife always wanted to go to Africa. So funny story. I'll try to make it quick, but my wife always wanted to go to Africa. Promised her on like our 10th wedding. We've been married for 30 years. I promised her on like our 10th anniversary that I'd take her to Africa, and it never came to fruition. Like it just never happened. I was always too busy. Like I said, literally 7 days a week, not every single week, but there were several times out of the year where I'm working, and I traveled a lot. My family actually lived on one island, and I traveled because we had stores in California and on almost every island in Hawaii. So I was gone most of the week, and I promised her and never came to fruition. So we retired, moved away, and then, okay, now to seriously start figuring out, okay, well, let's go to Africa. Let's set the date. Let's go to Africa. And in that conversation, we meet some gentlemen here that are from Africa, and we're talking about it. So we met one where he was like, yeah, it's okay if you donate money, but it's not that big of a deal.
Yeah.
His philosophy and concept was, again, that the whole adage that I'm sure everyone's heard, right? If I give someone a fish, they eat for a day, but if I teach them how to fish, they eat for a lifetime.
Exactly.
So it was more about fundamentally building businesses and building economic structure. So what we started was we started off because it was an easy lower barrier of entry for us, just as a virtual assistance company where we started bringing we established an entire community. We started educating them on various real world aspects, like they know how to use AI, they can build a website, they can do administrative work, pretty much all applications, like so something that they can use in real world scenarios. So I can grab them, drop and play, and then start bringing them income. And then it navigated into, and we do charity work as well. I mean, we'll do where we donate food or school supplies. Normally educational supplies we're kind of big into orphanages or schools. So we do that as well. But the main component is education. Sometimes we'll drop off school supplies at an orphanage and we require them to come into the community and start educating themselves on, because we have this whole platform on all types of education, even Riverside. I'm pretty sure we have a module for them to be able to understand Riverside, StreamYard. I mean, there's a ton. Canva, almost every single AI app you can think of. There's tools and education for them there that they can, again, use and apply to the future for them. Then it navigated to, okay, we need to develop a university structured around 5 pillars in overall economic growth. So it's computer engineering, agriculture engineering, electrical engineering, computer engineering, mechanical engineering. So all of those components to kind of fully uplift the overall economic outlook of a country. So it's big, very, very big goals. But I'm excited.
So how many people right now we have involved, and I'm assuming that you have a platform where thousands?
Yeah, thousands now.
So when they finish, they find their work through Upwork, or do you have a platform where you distribute them in the US, or how does it work?
It works both ways. We have someone on the ground trying to find them like local jobs. And then we also have opportunity where we go out and well, not we, but the entity goes and outsource clients for them. So it works full both ways. But the overall goal is to try and keep the economic opportunities there in the country. And I love America, so there's nothing against that. But too oftentimes people leave their country, like the top talent pools leave their country to come to the United States. And then obviously that sets the country back even further, right? Because top talent gets pulled away to the United States for more opportunities. So it's looking at, okay, how can we bring the education, bring the resources, And it starts with people, right? I mean everyone who knows world economics knows there's a huge opportunity in Africa, right? Just because of the human resources and the overall natural resources that are available in Africa. It's just politics obviously is a huge portion
Oh
of it,
yeah,
and then
yeah,
education and opportunity.
yeah, for sure. There's so much talent there. We have one gentleman working for us from South Africa. I know he's he's very well educated. No, you'll be surprised, and it's
No,
amazing.
yeah.
And congrats to you. And it's really, really inspiring what you do, guys. Though, really, really. I was
No,
there
I appreciate
once
it.
in Tanzania a couple of years ago with friends, and we climbed Kilimanjaro. So you can see that the continent is just poised. Is just poised economically. There was very different experience that I thought will be when I saw how much growth going on, how much growth we have.
Yeah, yeah, there is. I think Nigeria. So we're in 4 countries now. We're in Cote d'Ivoire, Nigeria, Ghana, and Botswana. And
Hmm.
I think I just seen something where Nigeria had like the top rated university in the world. So there's a lot of educated people there. There's just it's limited with the resources and the opportunities is probably what's most limited there. So that's what again our goal is to try and bring more economic opportunities and in the next few years impact the lives of at least 1 million people.
Oh man,
And who knows beyond that.
wow, that's amazing. Congrats. I really, really, yeah, appreciate it. We need more people like you in the world for sure. Yeah.
I appreciate it. Thank you again for having me on, Sal. It's been uh awesome time.
Thank you.
Kind of just sharing. I love sharing, just getting as much knowledge and education as we can out there, and hopefully someone takes some benefit from it and changes their path. And I mean,
Oh
just
yeah.
impacting one life is worth it.
Well, you inspired me for sure. You inspired me because I know, yeah, we're chasing money, freedom, and that always is changing goal, right? But obviously, the biggest joy and the biggest sense of called happiness or freedom when you were able to tap in that giving back frequency, right? And it's
Yeah,
just
it
so
is.
addictive and
It's
it's so
it's probably
beautiful.
the most selfish thing you can do, but because the joy you get from
Exactly.
it is like it's not measurable. If you
What you
guys,
get from it is indescribable.
yeah, yeah. Once you what you get from it is almost immeasurable.
Yeah.
Let me tell you one last story before we gotta jump off. We were in Africa, and we were meeting up with some of the people that we've helped. Some of the I would say more leaders of the organization there, boots on the ground. There, we organized this dinner, and we're out, and then one of the wives just come up to me and she said hi. It was normal. Hi. She shook my hand, and then she just started bawling, like completely crying her eyes out. I was like, oh my God, what did I do? Like, I don't even know what I did. I was like, I just shook her hand. What did I do? And then, I mean, she took her a while to even get the words out, but she was just so, like, sought with emotion on the impact that we've, like, absolutely changed their lives. And it was just a little thing, right? It's just giving them
Hmm.
more opportunity that completely changed the trajectory of their lives and hopefully their kids' lives and their kids' lives. And
Oh yeah.
that's what we got from it. And those types of experiences you just can't measure. Like, it's not
Hmm.
measurable. It's hard to even articulate how it feels like internally for me, but you just know that I mean at the end of the day it's one of the most selfish things. I think I heard Denzel Washington I think say it's one of the most selfish things that you can do, and it's true, like because
Yeah.
the reward that you get out of it is just that much more paramount than anything else. Like the feeling is better than dropping money on a brand new sports car.
It's immeasurable. It's
Yeah.
definitely manageable for sure. Yeah, I'll plug in just a little bit. We build houses in Mexico once a year, and
Oh, that's awesome.
same thing. The same thing. Where we say that this is from someone who is thinking about you. But one of it was last year. We went to the house we built 3 years ago, and it was just unbelievable to see. It's a small, tiny. We call it's not. It's like a garage. It's a garage size of the old house, right? But it's a home for these folks, and they have a normal family. They're not anymore someone homeless and bums, right? They just have a kitchen table, have kids coming from school. They go to school, and it's gonna be a family. It's not gonna be some dysfunctional couple, and it just unbelievable to experience that you have actually a thing to change it, even just something very, very small, right? No, but
Yeah,
it's
absolutely.
immeasurable how much selfishly of that happiness you fall in your bucket for months, for months
Yep.
that experience stays there within years.
Absolutely.
Yeah.
Absolutely. Well, congratulations on doing that too. That's phenomenal as well.
All right. It was great conversation. I really appreciate where people can find you if they want to invest in your fund or to find more about you. What's the easiest way to get in touch with you or with your company?
The easiest probably way is LinkedIn. Just look up Christopher Borden on LinkedIn. I'm pretty active on there. We both post almost every single day. We're pretty
Yeah.
active. I personally check all of my messages on LinkedIn. So if you want to get a hold of me, just message me through LinkedIn. That'll be the easiest way, and we can get connected through there.
Awesome. Thank you so much. You keep crushing and keep improving the world, and I really appreciate for this conversation. Thank you.
All right. I appreciate it. Thanks for having me on.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.